Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
Happy post Super Bowl 60. Calendar already says February 9th, so the year's chugging along. I guess our lives are just chugging along. How are you looking for retirement? We'll talk about that and more. Let's take a look at the stock market today. The Seahawks did their thing, and there's some sort of correlation between an NFC team winning the Super Bowl and the performance of the stock market. Of course, we're not going there, but hey, if it works in your favor, we'll keep that in the back of our head. The S&P 500 is up 36 points and at 69.68, getting close to an all-time high and getting close to 7,000. The Dow Jones Industrial Average has already broken 50,000. It's at 50,107, but it's down 8 points today. The NASDAQ is up 223 points, up 1%. So tech is leading the way. Mega cap tech is leading the way. Not all. Russell 2000 is up 20 points, up 80 basis points. Taking a look at some of the other areas of market activity. Everything in Europe did well today, moving slightly higher. The German DAX was up 1%. Again, international stocks, something you should not fear. Bitcoin's down $1,600 right now, down 2%, sitting at 69,608. Last week it got, I think, down to about 65,000. Ethereum's down 52 points, down 2.4% today. 10-year Treasury sits at 4.2%, making a little bit of a move closer to 4%. Which is where we have to get to hit one of those flags that say this is a safe road to be on, stocks versus bonds. Right now, bonds still get that slight favor. Elon Musk is pivoting his news headlines these days to SpaceX going to the moon away from Mars as the IPO approaches. I saw Databricks got another round of funding, just reminding me that we're going to have a lot of IPOs in the second half of 2026 that could take away from those NASDAQ 100 stocks, the Magnificent Seven of super valuations. Google's being sued by Autodesk over AI-powered movie-making software. Interesting. Not really. Gold's above 5,000 as the buy-the-dip buyers have returned to a choppy market. Sitting up 114 points today, sitting at 5,094. That's up 2.3%. Silver's up 6, sitting at 82.79. Some analysts are saying 100. No, we see $200. Whoa. I'm still in the camp that it's a little bit of a break momentum kind of play. And when it does break the momentum, it's thinly traded. And the repercussions are big on the downside, just like the repercussions are huge on the upside. It's not my kind of investment. I don't mind trading the issue, but it's not my kind of investment. Taking a look at some of the other headlines out there. Hims and Hers stocks crashes today as the FDA announces a crackdown on the GLP-1 compounds, which I guess the stock and the company was under the radar until they started copying Lilly's pill form of... I still love the way Trump said this, the fat pill. GLP-1 compounded drugs. Semaglutide is the better way of saying the fat pill, but still makes me smile. So the FDA is ultimately stepping in and it wants to take its intent to get decisive steps to restrict GLP-1 active pharmaceutical ingredients intended for use in non-FDA approved compounded drugs. If you own a small company like a Hims and Hers, 25% moves have to be expected in one day, either up or down. That's not reassuring if you're trying to manage wealth for your retirement, but I get why people do it. Taking a look at some of the stocks that you may own, may not own. Apple down $4 today, sitting at 273. Google up $2.60 at 325. Meta is a interesting winner because it's got a big number. It's up $11 and it's 672, up 1.6%. Nvidia is up 3.5%, back to $191. Microsoft's up 10, up 2.6%, 411. Trying to find all the Magnificent Seven stocks because I think that's what you own. Tesla's up $7, down 1.9%, sitting at 418. Oracle's up 13, up 9.7%. That's a big number. Tech names are leading with broadening strength today, resulting in modest gains for the index level, but still gains. There's some lingering weakness in Amazon after its earnings release last week. Yes, I still like Amazon, and to me, I like buying my favorite stocks when they're down, so I'm good with that. Unlike the Super Bowl, Friday's session was chock full of exciting plays, culminating in one touchdown after another for the broad universe of stocks. Don't you hate it when people push in and force things like, unlike the Super Bowl? Friday was a crazy day, though. Japan's Nikkei scored a big touchdown today, spiking the ball afterwards, gaining 3.9%. Prime Minister Takaichi's party won a supermajority in a snap election, even before accounting for the seats won by the LDP's coalition partner Ishin. Investors assume that the big election win will be an opening for additional fiscal stimulus, taking on debt as a nation. We now reward that on Wall Street and go, hey, money's money. Would we rather see corporations have the profits to fuel their expansion, or would rather see governments take on debt to fuel the private sector that might be publicly traded? Congress is going to be tangling this week over the Department of Homeland Security funding before Friday's deadline. Republican and Democrats remain far apart, so more politics. I can't believe how many people are willing to get in fights over politics, but man, it happens. Yep. So crypto-linked stocks are sliding today as Bitcoin tumbles back below 70,000. So when Bitcoin's down, strategy. I keep wanting to say MicroStrategy, but I can't because they've changed their name to just Strategy. They're down fractionally. Coinbase is up fractionally. Ticker symbol on Coinbase is COIN, COIN. Then you get into the iShares Bitcoin Trust, ticker symbol IBIT. They're down today. Airlines. I was looking back on Friday's trading, and they're all over the place. Now, again, the United States government is in negotiations with Iran on nuclear weapons. Thus, when things look positive, we might say, oh, oil prices can go lower. Iran's going to be allowed to sell their oil. We all feel better about it. But as a group, I do follow these guys. I don't necessarily invest often or trade. But keep an eye on United Airlines, Delta Airlines, DAL, which I think is my favorite based on profit margins. They tend to do international flights best, and their margin profile is most attractive. So I see names like JetBlue, Alaska Air. JetBlue, ticker symbol GABLU. Alaska Air, ticker symbol ALK. And I acknowledge them, but maybe I'd take a trade, but definitely not all that interested in taking a position. Let's power through some content. Today we get earnings from Open Door, Cleveland Cliffs, a big mining play. Monday.com. Good that they report their earnings on Monday, so I don't have to say on Tuesday that Monday.com and just confuse everyone. Tomorrow we get Robinhood. We get factory orders. We get December retail sales. How did Christmas do? We get earnings out of Coca-Cola, which could say, hey, our earnings and our margins are so impressive. Send some money our way, big tech companies. You could continue to see rotation because of Coca-Cola is reporting. Spotify, Fiserv, Marriott, Duke Energy, Lyft, Ford, Zillow, AIG, and Cloudflare all report on Tuesday. Then on Wednesday, we get McDonald's and AppLovin. AppLovin is one of those stocks that a lot of people love and a lot of people love to hate. Thus, I'm out. I don't invest in civil wars for mid-sized companies or small companies. I'm not going to say I don't, but I tend not to. It's the right way of saying it. But we also get earnings out of Cisco and Kraft Heinz on Wednesday. Then on Thursdays, we get Dutch Brothers, which is not the opposite of Starbucks, but fairly close. They're doing a lot of drive-thrus, plus a lot of focus on protein. Anheuser-Busch reports Thursday Applied Materials. That'll be an interesting with AI technology and capital expenditures for the semiconductor equipment makers. Pinterest is also on Thursday. Arista Networks. They're big in the data AI hubs. It's also jobs report this week on Wednesday. December's data was weaker than expected. So analysts will be watching to see whether the Labor Department hit the gym with everybody else in January and got stronger. Meta case gets underway with Instagram for the second time in 2026. Going to be in court. New Mexico's Attorney General alleges that Meta's social media apps expose children to the exploitation by prioritizing engagement over safety. You're already starting to see some European nations, Australia, starting to ban social media for people under 15 or 16. I hate the word ban, but I hate I hate what it does to my kids. For me, it's counter-programming and trying to reduce the effects. Genie's out of the bottle. Valentine's Day is right around the corner. If you're not a wordsmith, go to ChatGPT and have it write you a love poem. Try to write it like E.E. Cummings or someone who was really good at love poems. It's a cool thing that you can do with AI is say, write my monologue on stock performance day in the voice of Jimmy Kimmel, and boom, it'll put in the snark of Kimmel. OpenAI CEO Sam Altman tells employees that ChatGPT is exceeding 10% monthly growth. Company's going to introduce a new model this week. You're seeing Microsoft, Nvidia, Google, and I guess Alphabet respond well. Samsung said, that's almost like Simon said. Simon said, touch your toes. Simon says, rub your belly. Talk stocks. Oh, it got me. Samsung says it's starting large-scale HBM4 production as soon as this month, earlier than expected, ahead of Micron's planned HBM4 high bandwidth memory. Micron's doing that in the second quarter of 2026. Samsung stock is popping on that news. Micron is selling off on a competitive fear. If Samsung and SK Hynix ramp faster, investors worry Micron could lose early Nvidia orders for their new next-generation Vera Rubin platform. They could lose pricing power. They could lose share at the margin. A lot of short-term fear there, not long-term collapse. HBM demand is exploding, not shrinking. Wall Street still expects Micron to hold 20 to 25% high bandwidth memory market share, even with Samsung pushing early new chips. Nvidia and other AI chip makers want 3 suppliers, not 2. That reduces supply risk. It protects Micron's seat at the table. AI chip makers are converging on a 3-supplier sourcing strategy. Samsung move confirms the strength of the AI memory cycle. It doesn't take away from it. High bandwidth memory carries a much higher margin than standard DRAM. Even if Micron doesn't win the first wave of HBM4 orders, it could still sell everything it makes. It could still maintain strong margins. It could still participate in multi-year AI build-out. Supply chain risk is existential. High memory bandwidth. It's custom. It's difficult to manufacture. It's yield sensitive. It's capacity constrained. If one supplier slips on yields or packaging, entire AI systems can't ship. After COVID, geopolitics and fab accidents, single or dual sourcing is no longer acceptable for the industry. The generations move fast, HBM2 to HBM3 to HBM3E to HBM4. No vendor is dominated forever. Samsung's pushing early into the HBM4. When you sell high bandwidth memory, you have to work with hybrid bonding and chiplets. If one supplier's memory works better than with certain packaging flows, having alternatives keeps production moving. Micron has earned about 20 to 25% of high memory bandwidth share in 2024 and 2025. People see this as defending your market share, not losing it. Let's take a break here. When we come back, I got another segment plus for you on Oracle, on retail, on Roblox, on Telsey Advisory Group, on Eddie Bauer or Edie Bauer, Databricks. The next big AI play, is it appropriate for you? And maybe a word or two on Apple. You can always find me online at robblackshow.com. That's robblackshow.com. I do have an event coming up. You can go learn about it right now at going to robblackshow.com and hitting events. Let's take a break here. We'll be right back.
What's the best way to choose a financial advisor? Download our guide at robblack.com. That's robblack.com. Powered by EP Wealth.
We'll have a third segment today. Before I get there, let's run through some of my agenda. Cuba says international airlines can no longer refuel there as Trump turns up the pressure. It's going to be an interesting March to November with the midterm elections. Just a lot of conversation about what's working on Wall Street and why. If I ever sound political to you, it's just what I'm seeing and how my world of financial media and financial research blends with what's happening in Washington, D.C. Some stocks making some big moves today. Oracle up 9%. The enterprise software developer was upgraded to buy from neutral. Nexstar Media Group and Tegna, TV and digital media provider Nexstar up 12%. Tegna up 8% after President Donald Trump said in a social media post on Saturday he's reversing his earlier position by saying he now supports their merger. There was some more texting in there. We want this one to go through. Interesting that he reversed his position on it. And again, it just goes to show you that we have to talk about this. Kroger's up 6%. They named former Walmart executive Greg Foran as its next CEO, while head of Walmart's U.S. business Foran oversaw a turnaround in that division. Workday fell 6% after it said CEO Carl Eisenbach will be replaced immediately by Workday co-founder Aneel Bhusri. Previously, Bhusri had multiple stints as CEO and co-CEO of Workday. Company stock is down 45% in the past year as part of that. AI is killing everything in software play. Robinhood up 5% after an upgrade to buy from Wolf Research. The firm pointed to Robinhood's attractive risk-to-reward profile despite a recent pullback in crypto-connected stocks. Semiconductors are doing well today with Micron Technology shedding 2%, but Broadcom and AMD adding 3%. Waters Corporation, they make lab equipment. They're down 11% after they warned profits would be lower than analysts were expecting. Their first quarter earnings are going to be in the range of $2.25 to $2.35, lower than the expectations of $3.03. I always laugh at myself when I sneeze, so I just hit my sneeze button. I've got the worst sneeze if you've ever heard it. It's not like, blah, too. It's more like it. Now I digress. You ever get a day where you're like, did I just talk about that stock deja vu? Monday.com down 22%, hits a 52-week low. It's a platform project management. Issued weak guidance amidst concerns over artificial intelligence disruption of the software business model. Company forecasts that revenue for the full year will be between 1.45 billion and 1.46 billion. Analysts were expecting 1.48 billion. So the deja vu from Monday.com falling 22% goes back to Workday. And they're falling 6% after naming the CEO be replaced immediately. So I did hit on that. Let's take a look at the market numbers as the show grows. Not weary, but it grows on. The S&P 500 is still advancing, although starting to go sideways. So the early morning advance is starting to go sideways. Now, that's not bad. It's up 42 points, up 0.6%, sitting at 69.74. The Nasdaq's up 254, up 1.1%. The Russell 2000 up 22. That's up 84 basis points. At my Pints and Portfolio this weekend, one of the things that I said, we get into a conversation. I'm like, okay, you have three choices. Which one do you pick? And the choices I gave were Spotify, YouTube, and when I say YouTube, I'm saying Google, Spotify, YouTube, and or maybe Apple Music or Apple or maybe Meta. And if you're just doing it on the premise that I was going at for the argument, Spotify has to pay musicians to play their music. YouTube doesn't. Now, again, the infrastructure costs on YouTube are considerably higher than the infrastructure costs on Spotify. Spotify is going to report this week. I haven't pulled the trigger on owning that name individually, but man, it does look attractive. If they can continue to fight off Apple Music and Google Music, and how about Netflix Music? I don't know. Does that make sense at some point in time that they would add another vertical to their subscribers? Try and keep your eyeballs. One of the reasons Netflix added podcast was they looked at users' data, and most of their streaming happens between 6 p.m. to 11 p.m. when people are home from work. But when they're at work listening to a sports podcast, they're on Spotify. Netflix said, hey, we can license Spotify. We could license some of the other big players in podcasts. And maybe the mom or dad who's at home or at work listening to a beauty podcast, a sports podcast, a financial podcast, maybe will continue to get their not their eyeballs, but their ears, maybe their eyeballs if they're watching the podcast. So anyway, you always have to look for how much does the business cost to run. I guess that was the point of that in particular. A map showed that over 100 private jets departed the Bay Area within 2 hours of the Super Bowl ending. Around 1,000 private jets descended on the Bay Area ahead of the Super Bowl. People barely waited till the game was over and they're out. Quick getaway. 95 private jets using data from ADS-B Exchange departed between 7:30 and 9:30 Pacific Standard Time on Sunday. Game ended at 7:20. Just FYI. The San Jose Mineta International Airport, the closest airport's about 10 minutes away. I'm stunned. We haven't, as a nation, started cracking down on private jets. They're so bad for the planet as far as pollution goes. You don't need a reason to hate Kim Kardashian, but that's a reason. Her Gulfstream G650, which cost $65 million to buy new. It's registered to an LLC that shares its address with several companies owned by the Kardashians and her family. Her plane took off about 2 hours after the game ended and flew to Van Nuys Airport in Los Angeles. She was pictured at the Super Bowl alongside Lewis Hamilton, the F1 driver who she is rumored to be dating. Jay-Z and Beyonce's Global 7500 left just under an hour after the game. Also went to Van Nuys Airport. Jet's registered owner is a holding company that shares its address with Jay-Z's Rock Nation. So let's go back to that Oracle upgrade, shall we? They got an upgrade to buy because of OpenAI positivity. Analysts at D.A. Davidson bumped up their view on the stock from neutral to buy. They kept their $180 price target. It's currently right around $154. It's not about Oracle as much as it is about OpenAI when you read the research report. They think Oracle is going to be able to make good on billions of dollars worth of planned spending on computing power, OpenAI with Oracle, and with other hyperscalers. This is the end of the line for the private investment in OpenAI. Next will come the public IPO. We've never seen anything like this where a company stays private for such a long period of time that when it IPOs, it could IPO between $1.5 and $2 trillion. Same thing with Anthropic. Same thing with space. We've never seen companies stay private this long. Sam Altman told employees that the company was back to exceeding 10% monthly growth. Big trend there. Analyst Dana Telsey, she talked about retail. I like her advisory group. I read the research as often as I can. Her quote was, identifying themes of retail success entails pattern recognition. This past week, 2 companies illustrated success from enhancing the core, which is investing, refreshing, and introducing updates to heritage products, adding newness and improving operations. For example, Coach, ticker symbol TPR. That's Tapestry. That's the mother company of Coach. Saw strong gains in handbag revenue in December, with handbag revenue and units each increasing at mid-teens rate. Similarly, Ralph Lauren, ticker symbol RL, experienced momentum in its core business in December, showing a low double-digit increase led by sweaters and knits. We are going to get December retail sales this week. Roblox got an upgrade to buy over at Roth Capital. Stock's up big today, up 5, up to $71 a share. Roth said, we have a positive view towards Roblox due to better than expected 2026 booking guidance and a greater than 20% bookings compound annual growth rate over the next several years. We're increasingly appreciative of the underlying mechanics of the platform, having created a strong, sustainable, virtuous circle where continuous improving creator development tools are producing higher quality games, which enhances the user experience. I look at Roblox as kind of Minecraft for the under 10 crowd. My kids barely played with Roblox 5 years ago. And the games are really, to me, from what I saw, and I don't know this thoroughly inside and out, so don't go out and do anything on Roblox based on my ignorant opinion, but the games were like, make a pizza, slap the dough, sauce the pizza, sauce the dough, cheese the dough, put on pepperonis, put it in the oven, wait 2 minutes, deliver pizza to customer, get ding, 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 ding rewards. Do the same thing again. Do the same thing again. Do the same thing again. Eventually buy a bigger pizza oven. Very repetitive, but kids like repetitive games. Eddie Bauer filed for bankruptcy. The operator of roughly 180 Eddie Bauer stores across the United States and Canada has filed for Chapter 11 bankruptcy protection. I had some of their clothes in my closet growing up. They're blaming declining sales and a litany of other industry headwinds. I bring this up as success or failure. Quick note with you. So Eddie Bauer is a storied brand. It was a Seattle fishing shop. It was later outfitted to make thousands of newfangled down jackets and sleeping bags for the military during World War I. Eddie Bauer's namesake founder was an avid outdoorsman, started the company in Seattle in 1920 as Bauer's Sports Shop. In 1945, after making more than 50,000 jackets for the military, it launched a mail-order catalog. Bauer's Sports Shop was not just a place where people purchased clothing and gear, it was a community. People would come and talk about their wisdom, and they'd learn from each other, talk about their experiences in the outdoors. The company created an American Goose down insulated jacket known as the Skyliner in 1936, and it became the company's first patented jacket. It outfitted the first American to climb Mount Everest, James Whittaker, with an Eddie Bauer parka in 1963. Bauer retired in 1968 and sold the business to his partner. That's when the brand started shifting and changing and shifting and changing. In 2001, it had 600 stores. It was bought by General Mills in 1971. You can imagine General Mills, yes, the company that makes cereal. Anyhow, let's move on. I bring up the death of companies on occasion because I shopped there. So there's a little bit of nostalgia, sharing who I am, but also the idea of things change. Hims is going to stop offering a copy of Wegovy pill following FDA scrutiny. Said the company decided to stop offering its newly launched copycat version of Novo Nordisk's Wegovy pill. Shares of Hims is down double digits. Novo Nordisk is up 6%. The FDA said it would take decisive steps to restrict GLP-1 compounding. The Department of Health and Human Services General Counsel Mike Stewart said on social media he had referred Hims to the Department of Justice. Databricks, they're eventually going to come public. And it's one of the things that I'm talking about. Companies that are private, that stay private long time, continuing to raise money, staying out of scrutiny, not having to get cash flow positive. When you study venture capitalists, they have no problem throwing money and seeing companies burn through it. Now, what we're seeing OpenAI and Anthropic burn through, one of them is going to be a winner. And maybe one will be a loser, a lot like Google and Yahoo. And do you remember Yahoo and Alta Vista ruled the search engine world? And then there was Google who was getting the venture capital money, and they kept burning through it. They just simply had created a better algorithm. But similar to the 1990s and the early 2000s, the more money you burn, you have to show a different metric. And one of the metrics that they're showing now is dynamic margins, and it shows you who the most profitable customers are of the services. OpenAI is going to copy their business model after the most productive and economically viable customers. And they're just throwing a lot of revenue to create revenue, and it's evaporating faster than ever. It's got some people freaked out. Databricks, back to Databricks. They completed its latest round of funding, $5 billion at a valuation of $134 billion. They provide software that helps companies manage large amounts of data and build their own artificial intelligence models. That company will come public in 2026. Apple's is the only big company, tech company, whose CapEx declined last quarter. So if you look at Amazon, Alphabet, Meta, Microsoft, they all spent record sums last quarter on purchases of property and equipment, largely tied to AI chips and data centers. And for the companies that offered forward-looking guidance, their CapEx plans were more than generous and sometimes almost doubled. Amazon expects its CapEx to surge to $200 billion. Google's aiming at $175 billion to $185 billion. Meta is between $115 and $135 billion. All those figures weigh on their stocks. Microsoft didn't give a formal number, but it's looking at roughly $114 billion. Now, Apple, on the other hand, is just a fraction of its peers. They actually declined in the December quarter from a year ago level. They struck its own path with AI, though. It's embracing AI, but not an AI company. Instead, it's chosen a hybrid model relying on both first and third-party data centers. A move that keeps a significant amount of the infrastructure spending off its balance sheet. Apple has said it expects CapEx to increase as it invests more in AI, particularly to support its private cloud compute. But those are minimal compared to what Apple's peers, Alphabet, Amazon, Meta, and Microsoft are spending. The Google deal is worth about $1 billion a year, giving Apple access to the top-tier AI model for pennies on the dollar compared to what they're spending to build it. Speaking of that, Google plans $15 billion in a U.S. bond sale as CapEx surges. What once was company asset light, companies like Google, Alphabet, and Meta are now piling on debt. $15 billion is nothing to sneeze at. Now, again, they're getting great debt ratings. And this is a 2066 bond, so it goes out 40 years. It's being priced around 120 basis points over treasuries. Do I believe in Google for the next 40 years? And the answer is yes. Is it too early to say that? Probably. If you go back to the 1990s, i.e. 40 years ago, some of those companies are no longer here. A lot of mergers and acquisitions happened. And it's unfortunate. If you were to look at my favorite stocks in the 1990s, if there was a list of 25 of them, one or two of them are gone. And some of them are obvious, like, and I don't want to say obvious like, but name like Juniper Networks. A lot of .com companies just went away and they never came back. Some of them merged, some of them got acquired, some of them went bankrupt. It should be humbling to you when you start thinking about some of the names that you used to like. I remember going on Fox TV, Fox Business, way back in the day. And I got criticized because one of the stocks I liked was GE. And I think the quote that I threw down was buy GE, not Gee Whiz. Because he's speaking, what they're looking for as far as marketable moments for commercials. But if you go back to the 1990s, there's names like Brocade, Juniper, Mercury Software, Siebel, Vignette, Yahoo, AOL. Companies do disappear on occasion, just like Edie Bauer. Do you remember why I brought that one up? For that obvious reason. Later today, I'm going to be talking about who one of the big AI winners is. That'll be my afternoon podcast. It's an AI winner who you're not thinking of as an AI winner. And it's a 175-year-old company. I got to tie a quote to the company to a Willy Wonka scene. And it was the Willy Wonka scene where they end in the elevator. It was one of the coolest scenes I ever saw in my life because I'd never seen a glass elevator. So that's your hint on the company this afternoon I'm going to talk about as a potential AI winner for you in your portfolio. Let's take a break here. Come back. One more segment all about Google and Amazon's earnings last week. Stay tuned for that. I'm Rob Black.
Questions about Social Security? Check out the Social Security Retirement Guide at robblack.com. That's robblack.com, powered by EP Wealth.
Alphabet's latest earnings did more than deliver a strong quarter. They provided a real-time case study for how the AI trade is evolving from the narrative-driven enthusiasm into a capital-intensive, return-focused regime. If earlier phases of the AI trade rewarded belief and optionality, the current phase rewards scale, integration, balance sheet strength, and the ability to absorb near-term pain in pursuit of long-term control. Alphabet sits at the center of this trend. Its results, capital spending plans, and market reaction capture the tension that allocators now face across the entire AI ecosystem. Extraordinary operational momentum is being paired with skepticism towards the magnitude and timing of returns on capital. I would say this is a start and stop, an ebb and flow angle that I want you to grasp so you can survive it. Alphabet's fourth quarter and full year results reinforced why it remains one of the most powerful businesses ever constructed. Revenue grew at 18%. Annual sales surpassed $400 billion for the first time, and growth was broad-based across search, cloud, YouTube, and AI-driven products. The breadth matters here. Unlike narrower AI plays, Alphabet's earnings are not dependent on a single monetization lever or technology cycle. Advertising continues to throw off enormous cash flow. YouTube has quietly become a global media platform, generating more than $60 billion in annual revenue. And cloud is transitioning from proof of concept to a proof and profit engine. Alphabet can fund the future using the cash flows of the present. Part of their capital expenditures also are tied towards Waymo, the self-driving cars, and not AI. Search was supposed to be disrupted. Instead, it's expanding. I look at Google as a government-sponsored monopoly at this point in time because they were deemed by the government of the United States to be a monopoly, and they couldn't really figure out how to punish them last year. That's one of the reasons you want to own Alphabet/Google. AI-enhanced search is driving higher engagement, increased query volume, and improved monetization. Rather than hurting search, AI appears to be deepening user reliance upon it. For a business that remains Alphabet's economic engine, this fundamental change helps the risk profile enormously. Google Cloud delivered 48% year-over-year growth alongside expanding margins, signaling a shift from experimentation to execution. They have what OpenAI wants. They've got emails. They've got storage. They've got a full ecosystem of users right now, both on a business and consumer level, that they're starting to leverage intelligently. Alphabet is beginning to quantify traction in generative AI. The Gemini app now has approximately 750 million monthly active users. The company processes roughly 10 billion tokens per minute through its API. Those figures are still early, but clearly they're establishing a relevance at consumer and developer levels simultaneously. Alphabet is a lot like Netflix. They've got 325 million paid subscriptions across consumer services. The ecosystem depth is a form of risk management. Alphabet's revenue mix makes it harder for any one disruption to derail the whole trade. They're issuing bonds now, 50-year bonds. I think that's the time horizon that I have on them. Over the past year, Alphabet has outperformed much of the Magnificent Seven, including Apple and Nvidia. This shift changes the narrative that AI leadership automatically belongs to the hardware or consumer device champions. Alphabet's experience mirrors the broader AI regime shift. Scarcity still rewards upstream suppliers like Nvidia and Broadcom. Hyperscalers such as Microsoft, Amazon, Alphabet are absorbing margin pressure in exchange for long-term leverage. Software companies face uncertainty as markets struggle to price future value capture. Let's move on to Amazon. Amazon's latest earnings reports triggered a familiar reaction. The stock slid after a modest earnings miss, softer near-term profit guidance, and most notably a staggering capital expenditure approaching $200 billion for 2026. The response was anxiety over margins, skepticism about returns, discomfort with numbers so large they feel almost abstract. That's the short-term investor. That's not me. At the surface level, Amazon's fourth quarter results were not weak. Revenue grew 14% year over year to $213 billion. Amazon Web Services revenue rose 24% to $35.6 billion, driven by strong demand for AI workloads and outpacing Wall Street expectations. Subscription revenue, led by Prime, increased 14%. Wall Street loves subscriptions. Operating income guidance, $16.5 billion to $21.5 billion versus expectations of $22.2 billion, reflects spending choices, not demand deterioration. Amazon Web Services remains central to Amazon's long-term thesis. The cloud business continues to grow faster than the broader company, fueled increasingly by AI-driven workloads. Demand for training and inference capacity is accelerating. Customers are committing to a longer-term infrastructure contracts. AI workloads are capital-intensive, sticky, and deeply integrated into customer operations. Once deployed, though, they're difficult to migrate, reinforcing Amazon Web Services' competitive position against Microsoft's Azure and Google's cloud. Amazon Web Services is not simply a cloud business, it's a toll booth on enterprise adoption. One of the most underappreciated aspects of Amazon's AI strategy is its investment in custom silicon. Trainium and Graviton chips now generate a combined annual revenue run rate exceeding $10 billion. A lot of their CapEx is going into making these chips for themselves and for others. They offer customers lower cost alternatives to third-party accelerators while improving Amazon's own unit economics. For the big allocators, custom silicon is a signal that hyperscalers are no longer content to rent critical inputs. They intend to control them. Amazon's plan to invest roughly $200 billion in capital expenditures during 2026 dominated the narrative. The figure is enormous. It requires average daily spending north of $500 million. And understandably, it's unsettling. I get all that. Margin compression as a strategy, not as failure, is the theme that I want you to walk away with. Near-term margin pressure is explicit cost of Amazon's strategy. Operating income guidance disappointed because the company is accelerating spending ahead of the revenue realization. This dynamic's uncomfortable for people in the public markets, but one of Amazon's enduring strengths is the diversity of its revenue streams. Alongside Amazon Web Services, advertising has become a high-margin growth engine. Physical retail, while less glamorous, generates scale and data. Subscriptions create recurring revenue and customer lock-in. It allows Amazon to fund massive investments without relying on external capital markets as smaller or more narrowly focused competitors. For allocators, this breadth reduces existential risk even as headline numbers grow larger. I'm Rob Black, talking all things financial.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.